data, you can still get that if you have your accounting done, if you have done the accounting permanently, right? So that's the importance of accounting. Okay, for all the new students who have joining in today. Okay, for all the new students who have joining in today. For the benefit of you all, I'm going to quickly, guys, walk you through, why do we do the accounting. So the first thing about the accounting is that you need to have a permanent record. So even if you want to get something into the future, right, you need some data, which is like a backdated kind of a data. You can still get that if you have your accounting done, if you have done the accounting permanently, right? So that's the importance of accounting. That's number one. Measurement of outcome is also important. Most of the outcomes are basically into the financial matters. So you check how your business is performing financially and not any other way out. So you need to understand what's your cost. Okay, what is your profit, how much money you've made in a financial year, right? How you're taking care of your cost. So I can say cost, efficiency, we can probably put in here. So yeah, we can say that how are you taking care of the cost. So that's number one. And that's number two, rather. Otherwise, credit worthiness, definitely whenever you need any kind of a loan, you can always go to the banks, or you can say that you can go to the financial institutions, and financial institutions can see your accounts and they can probably give you the loans eventually. Efficient use of resources, again, how much resources, which is like fixed assets you have, how you are using your cash, your accounts receivables, so on and so forth, right? How you guys are managing these things, that is again kind of taken care by your accounting if you have the accounting. And definitely whatever business that you have done so far, what's going to be your future business, how your future business or your future earnings look like, that can only be possible when you have accounting with you. If you do not do the accounting, then it is not going to be possible for anybody to understand what are going to be your projections. So what you have is, you have the historical data. That's number one. Historical data plus what you have is you have the current data, right? On the basis of these two, what you get is called as your projections. Now, how do you do the projections? That's something we're going to do later on. FAP guys, like financial analysis program people, you will be having some sessions with me as far as the projection is concerned. So we'll be doing projections in detailed manner later on. Now I'm going to move to the entity concept. And I want you guys to be a bit active in this session now. So let's say there is this guy. Okay, this guy is like pretty hardworking guy out here. Okay, so let's say he has done his MBA from say XYZ college, and he's making say what, like how much? Like say he's making say 10 lakhs per annum. That's his capital, rather that's his the year's income. That's CTC, cost to company. So he's making say around about 10 lakhs per annum. Now it's quite possible for this guy to kind of keep the accounting record for himself. So whatever money that he's making, whatever salary that he's got, and minus all the expenses out of that salary, he can kind of keep that data very nicely. And then at the end of the day, rather at the end of the year or at the end of the month, this guy can understand what is his basically disposable income. Now, what do you mean by disposable income? People who do not understand disposable income, please pay attention. Disposable income is that income which comes to you, or which is in hand income, or in a finance language we call it as in hand salary. So disposable income is that income which comes in your hand after paying all the taxes, all the dues, whatsoever, right? So you've got this guy out here who's doing well in his life, and he can keep the record. It's like pretty much normal, right? Now let's say this is Robin. So we're Robin here. So Robin is there. Let's say we've got another guy out here. So there's another chap out here. Say his name is Mark. All right. So say Mark is a good guy. Unfortunately, Mark couldn't make it to a good B school, and he started with his life with say 7 lakhs per annum. That's his cost to company. And he's not really happy about it. But let's say that Mark is a pretty good digital marketing guy. He has done a program or a course with say a digital marketing, right? And wants to venture out in digital marketing. So what he does is Monday to Friday he works in a corporate world. Saturday and Sunday he starts his own company in the area of digital marketing. Now what happens eventually? Say he's making a couple of money from his company, which is like whatever company that he's working with. So that's 7 lakhs. And eventually his business kind of kickstarts very well, and he starts say making around about say 13 lakhs per annum. Fine. So if you look at the total, right? So what he had earlier 7 lakhs per annum, and now he's making 14 lakhs per annum. So the total comes here around about 20 lakhs per annum. So that's a good amount of money that he's making on a year basis, right? Now, if you look at the problem here is that, so we've got these two folks out here, and that's the problem here, because there's one person who can easily manage his all expenses and everything and keep the accounting. But now when you look at Mark, right, as far as Mark is concerned, the problem is he has to manage both the things. One is his personal account, another is business account. Now it gets a little bit tedious to manage both the things at one shot, because he needs to understand how much money he is making from his salary, how much is the disposable income that he's making from his salary, and whatever money that he's making from his business, right? So that's the main thing. Now, when you have this kind of situation, it creates a confusion in the measurement that I need to understand. I can see my salary into the account. I can also see my business income into the account. I can might as well have, say, ICICI bank account for my personal, rather my salary account. I might as well have, say, Standard Chartered account as a business account. So I have two accounts, but at the end of the day, right, I want to understand how much money I'm making from my business, and so how much is my disposable income at the end of the month or at the end of the day. And that's where, if you look at somebody like Robin, is going to be in a good position, because Robin does not have any other income, right? It's only one income. So whatever money that he get, per month, he can just keep on spending that, EMIs and all that, and whatever has been left gets carried forward to the next month, something like that. But it's a problem for somebody who is Mark. And that's the reason, when you have more than one income sources, maybe you're a working professional and you have another business, or maybe you're a businessman and you have a couple of businesses, then it becomes a little tedious to kind of do the accounting. And that is the reason, if you look at, to kind of address this kind of situations, we have something called as entity concept in the accounting. So entity concept is a beautiful concept which basically separates two different entities. So if you look at what we studied in the in the company's formation, that company is different than the person. So maybe you are the owner of the company, but if the even if the owner dies, the company will still move on because of perpetual succession. So you have something called as perpetual succession, because of which the company will go on and on, because company is an artificial person created by law and it has a legal status. So even if the promoters die, company is not going to die. What company will get is, probably company can get liquid, liquid as liquidation can happen, or company might get wind up, right? So all these things can happen for a company to kind of get close. So that's where entity concept, what it does is, it separates two concerns. So in entity concept, what we say is personal income is different and business income is different. You're going to do the bifurcation. So you're going to keep your company's balance sheet, company's income statement different, and you will be keeping your own balance sheet, your own income different. So you can still have your personal, financial statements. So as a person, you can still have your own balance sheet. You can have your own balance sheet wherein you can say that, this is my liability, these are my assets. In assets, you can have your land, probably your building, probably the shares which you have, probably you will have cash in there. Liabilities, you will have, say, education loan, probably a housing loan. You will have to take this once you get married. You'll probably have a, XYZ stuff, which is like, a liability, which is going to be payable in the future period, right? So this is what you do for your personal thing. But, even if you look at companies will have to do the same stuff, right? So I will have a balance sheet of a company wherein we will have liability as capital, which we have studied earlier. We will also have assets. Now in the assets, we can have probably, say, machinery. We can have, we can have the investments. We can have, right? We can also have cash, no doubt about it. So all this stuff, right? Loans can also come in here. So we have balance sheet, which is for a company, and we also have balance sheet, which is for an individual, right? Okay, for all the new students who have joining in today, for the benefit of you all, I'm going to quickly, guys, walk you through why do we do the accounting. So the first thing about the accounting is that you need to have a permanent in the accounting. So entity concept is a beautiful concept. Personal income is different, wherein we will have liability as capital, which financial statements. So as probably company can mark accounting, but not, it's quite possible does not have any other income, right? Address this kind of get close. Building, probably the shares which you have. Personal income is different and business income is different. You're going to do the bifurcation. So you're going to keep your company's balance sheet, company's income statement different, and you will be keeping your own balance sheet, your own income different. So you can still have your personal, financial statements. So as a person, you can still have your own balance sheet. You can have your own balance sheet wherein you can say that, this is my liability, these are my assets. In assets, you can have your land, probably your building, probably the shares which you have, probably you will have cash in there. Liabilities, you will have, say, education loan, probably a housing loan. You will have to take this once you get married. You'll probably have a, XYZ stuff, which is like, a liability, which is going to be payable in the future period, right? So this is what you do for your personal thing. But, even if you look at companies will have to do the same stuff, right? So I will have a balance sheet of a company wherein we will have liability as capital, which we have studied earlier. We will also have assets. Now in the assets, we can have probably, say, machinery. We can have, the investments. We can have, right? We can also have cash, no doubt about it. So all this stuff, right? Loans can also come in here. So we have balance sheet, which is for a company, and we also have balance sheet, which is for an individual, right? So both the financial statements are made for both the concerns, right? Now, what's going to happen here is that so companies' accounts is different and owners' accounts are different. You cannot mix them up. So say somebody has started with a company and the initial capital is, say, around about, say, 10 crores. Okay. Please pay attention to whatever I'm saying now. If somebody starts the company, so if somebody's putting, say, 10 crore, say there is a student of mine, Vaishak, right? So say Vaishak starts a business with, say, 10 crore rupees. So what's going to happen is that in the balance sheet of Vaishak, he can say 10 crore as an asset. An asset will be 10 crore out here. Okay. But in the company's balance sheet, you can very well see this 10 crore in liability. Why? The reason is, now you might get confused saying that, but both these people, right, they are same, because this guy is the owner. He has put in this money into his own business. So why it should be shown as liability? However, if you look at right, as far as Vaishak is concerned, this is his asset, but this is a different entity. This is a different entity. So for Vaishak, in his personal balance sheet, it is an asset. But for a company, it is liability, because when company gets wind up or when company gets liquidation, right? If it's a liquidation kind of a thing, then this company will have to pay money back to the stakeholders or shareholders. That is the reason this is called as liability. And that's the reason in entity concept, you treat both these entities in a different way altogether, right? You do not mix them up. And that is the reason the legal status of both the entities is going to be different. So as I said, like, even if the owner dies, company will run, and even if the company gets wind up, owner is alive, he can create a couple of more companies. And that is the reason in the accounting pattern, we take entity concept very seriously. And that's what is basically applied. I'm moving ahead. Implications. Fair enough. So now let's take an example. Yeah. As far as your implications are concerned, right? Your legal implications are not there. So say this is the company, right? And if the company is getting bankrupt, right? So you have shareholders, right? You have shareholders. Now, if this is a sole proprietorship or sole trading concern, we have done this in last lecture. If it's a sole trading concern and if the business gets into losses, that sole trader, or rather that businessman or that person, he will have to kind of sell off his own assets to kind of pay off the debts, or he will have to sell off his own property to sell it to the people, right? 1 second. Fine. So he will have to kind of sell off his own assets. But is this going to be happening in the case of a company? No, it's not going to happen in the case of a company. As a shareholder, you don't have to, sell off your own assets and everything to kind of, go ahead and, pay for your company's debt. In the same way, as a promoter, you don't have to sell off your own assets, because, as I said, both the entities are different. So the owner doesn't have to go ahead and sell off his own property and all that. And that is the reason. If you look at capital appears as liability. That's what I explained it to you a couple of minutes back. Because both the entities are different, this capital out here is going to act as a liability, because that is something company will have to pay, right? Now the next point here is that profit appears as liability also. Now if you look at whatever profit that the company is going to make, even that is going to be a liability, because that is something that company cannot retain. Ideally, yes, company can retain that profit. It's up to the company, or it's up to the CFO and the top management that you can retain that profit. But there is something called as dividend, which you have to pay to your shareholders. So yeah, again, it's a liability, because say if you're not paying dividend to your shareholder, then what's going to happen to your profit? Now let's understand, where does the profit come from? Profit comes from your income statement. So you make the income statement. In India, it is called as profit and loss account. International accounting, it is called as income statement. So if you are making or preparing income statement, in a nutshell, what you have is you've got revenue minus cost. That's your expenses. Whatever is left is profit. Now, if your profit is say around about 1 crore of rupees, from this profit, first of all, you will have to pay to the creditors, let's say debenture holders. This is something left. We will be doing that in the next class. Then you will have to pay to your preference shareholders. And then whatever is left, it has to go to equity shareholder, right? So the equity shareholder will be receiving the money in the end. But then again, it's not a compulsion for a company to pay every equity shareholder. Company says that, you know what, this month or this year, we're not going to pay you even a single penny. We won't be paying you. Then what is going to happen to this profit? So company says, you know what, we will be transferring this profit to somewhere else. So when you transfer this profit, where you will be transferring this profit? So as a company, you have a couple of options. So first thing is that reserves and surplus. So why it is required? Reserves and surplus is important because you cannot just keep on giving dividends to your your shareholders. You have to keep certain amount of money for the future. That's called as contingent liability. Something that may occur in the future which you cannot foresee, right? So for example, if there is a tsunami, right, that takes place, or maybe there is an earthquake that comes, right? And if the company's office, shatters, like, if there is an earthquake, right, you're taking a lot of losses now. Then how you're gonna go ahead and rectify those losses? You can use your surpluses. You can use your reserves, right? Simple. This is nothing but can be called as savings for that company, to be very honest, right? Fine. Then comes, if not reserves and surplus, then what? Then there is something called as provision for bad debts. Now listen to me very carefully. Provision for bad debts. What does that mean? It means that as a company, you gave somebody, say this guy Vaishak, right? He's got his own company, and he's into say garments business. So he's a wholesaler. He gave say around about say 50 crores garments to the retailers in Mumbai, and they said that, sir, we don't have money to pay you right now. Can we pay you this after a month's time? He says, that's fine. You can pay me money after a month's time. Now, what happens if these guys do not pay him back? So out of like some part of the profit has to be booked under provision for bad debts. If those people are not able to pay in the future, so 50 crore, which was receivable, he created provision for 50 crore. So whatever the profit that he's been making over a period of time, he created provision for bad debt as 50 crore. So if these guys are not paying him 50 crore, which is going to be lost, that's minus. He has his reserves and surplus, or he has made a provision for bad debts. So you can utilize this money out here, and that's how it gets nullified. Fair enough. So you can put your profit amount into reserves and surplus. You can put a bit of profit amount into your bad debts provision. And if nothing else is there, and if you're making good reserves, or if you're making good provision for bad debts, what you can do is, as a company, you can move this money. You can move this money from P&L or from income statement to something called as balance sheet. Now, when you move this money from your P&L to balance sheet, what this thing is called as? It's called as retained earnings. This is one of the most important thing in finance. A lot of questions will be coming around retained earning. So retained earning is basically what happens. You move that surplus profit without paying dividend to your shareholder, and you park it to the balance sheet. That's called as retained earning. Now, where it goes, how it works, everything, we will be doing that in detailed manner in some time. Now, any questions so far? Guys, any questions so far? Are you guys with me?
Yes.
Any questions, guys? Clear enough till now, what I'm saying? Okay. Whatever we are doing currently, this is going to be your first year, first semester MBA Finance. All right, cool. Okay, let's get started with another point now. Okay, so let's move ahead. That's a repetition, by the way. So sorry for that. Okay, the most important aspect of your fundamental principles of your accounting. Now, the first thing that you need to understand is that whenever you talk about accounting, monetary unit is the one thing that we talk that, okay, this is one of the principle of accounts, is that everything is going to be in money terms, right? Everything is going to be in money terms. So we here are not talking about something called as barter. So we're talking about money purely out here. So that's the first principle. The second principle is basically going concern. Now, this is very important. The going concern means company is not going to get bankrupt, or company is not going to get liquid, or some company is not going to get kind of winding up and all that. Why? Because as I said, when we talk about the owner and we talk about the company, right, both the entities are different, right? Rather saying different, it's a single entity concept that we are using out here, and that's the reason, as I say, it is possible. Rather, the principle is that company will always go on and on. Now let's go back to the kind of objective that we did as far as the accounting is concerned. We had one objective that's called as credit worthiness, right? Now, why we had this on the slide? for the fact you assume that, company is a going concern, company will be paying your debts back to you. So say there is a company, who borrows, say they borrow, say what, like, 10 crore from a bank. So if they borrow 10 crore from a bank, why bank will give them 10 crore? Because bank knows that, company is a going concern. Even if the people do not turn up, people change, promoters change, whatever happens, for the fact the company is going concern, the money will be paid off eventually. So that's the second important principle of accounting. Then comes principle of conservatism. Now this is the most important thing that you all need to understand if you're really, really keen on finance as a career. This is something you guys need to understand very well. Now, what do you mean by conservatism? Conservatism ka matlab hai, right? You're going to be very much choosy. Rather, you're going to be very much cautious, right? Whenever you go ahead and try to do the accounting, books of accounts. So when you talk about the revenue, right? When you talk about the revenue, so revenues are not always reported on a very higher level. They're always reported at a minimal level. Revenues are always reported at minimal level, and all the expenses are basically reported at the actual cost. They're actually reported at the actual cost. Fair enough. Now that's called as being conservative. So revenue you will not increase, and the expenses you will not minimize them. You will always put your expenses at a cost. Let's take an inventory example. Let's say there is a land. Okay, there's a small land. Fine. Now let's say somebody who's got a house in Sobo, that's called as South Bombay. So somebody has bought this house, say around about say 10 crores. Okay, and that guy is making his own balance sheet, or say company has an office at South Bombay at 10 crore, right? Whatever it is, right? Now, if you see that, like, you bought this in say 2015, and today is say what is it? Today is 2019. Now, public tells you, or the valuation, real estate guys tell you that this 10 crore has gone up to 30 crore, right? But you will never ever report this inventory, or you will never report this asset at 30 crore, because if you look at this at 30 crore, right, what's going to happen is you are actually overestimating your asset, right? But market says it's 30 crore, but you're still going to record, or you're still going to account that inventory or that product, that unit, that asset at 10 crore. Why? Because if you move it from 10 crore to 30 crore, that's not going to be correct accounting, because as I told you, it has to be a monetary terms. So once anybody who actually pays for it, or if somebody pays for it, then you can put it as 30 crore. So say in May 2019, company wants to sell off that asset, and in that case somebody literally pays 30 crores to company, then that asset can move to 30 crore on the balance sheet from 10 crore, but not without any kind of a money, or not without any kind of a payment. And that is the reason it's very important that in the accounting you should go with the conservatism. You should always not by doing any kind of a manipulation, but you should always report your expenses, actual expenses. You should always report your actual expenses, and you should not report revenues more than what you have earned. So you should always keep your revenues whatever that you have earned, right? So say today at the end of April, right? Company says that, oh, you know what, we're going to get say around about 3,000 crore from a client. That's what company says. And then what company does is company prepares the financial statement, and they add 3,000 crore to their revenue. But that's not correct. Company should not be adding that 3,000 crore to their revenue, because you have not got it yet. And as a principle of conservatism says that whatever money that you have in your bank account, try to show that only. Do not go ahead with the futures earning. Fair enough. So that's the third principle. Fourth principle is cost principle. All the assets will be predominantly reported at the cost value and not at the market value. There is a concept called as MTM, mark to market. We will be doing that later on. There are certain exceptions out here. There are certain derivative securities. There are certain financial securities which are not actually reported at cost. They are reported at their mark to market kind of a price. So yeah, that's something as an kind of an exception. We'll do that later on.